Hello everyone, welcome back to Swadhyay. In the last class, we have completed revising income under the head salaries. Today we are going to discuss income under the head PGBP, that is profits and gains from business or profession. This is the chapter overview. We are going to discuss each and every topic in the given order. Coming to the first section in PGBP, that is section 28, charging section. So for individuals or for associates in general who are not engaged in any employment, they are engaged in any business or profession. For such individuals, the income will be taxable under the head PGBP. Whatever income they earn through the business or profession, it will be taxable under this head. So what does section 28 say? The various items of income chargeable to tax as income under the head PGBP are as under. Section 28 has listed out few items which are considered as income and are hence taxable as per the income tax provisions. Let us go through them one by one. Income arising to any person by way of profits and gains from the business or profession. Any income from the business or profession run by the assessee. Any income the assessee earns through his business or profession is taxable. Any compensation or other payment due to or received in connection with the termination or the modification of any of the terms and conditions relating to the termination of his management or office, agency, any contract or agreement relating to his business, etc. Any compensation received by the assessee which is in connection with termination of his management or office, or if there is any modification in terms and conditions relating to any agency, contract or agreement of the business of assessee. Such compensation amount is considered as income and hence taxable as per section 28. Income from specific services performed for its members by any trade, professional or business. Here any trade or professional business is performing any services, specific services to its members, and income earned through such services is also considered as income as per section 28 and hence is taxable under the income tax as per the income tax provisions. Incentives received or receivable by assessee carrying on export business. If the assessee is carrying on any export business, the incentives which are received or receivable by such assessee are considered income and hence are taxable. There are 4 examples of such incentives. The first one is profit on sale of import entitlements, cash assistance against exports under any scheme of Government of India, customs duty or excise repaid or repayable as a drawback, profit on transfer of duty entitlement passbook scheme or duty free replenishment certificate. These 4 incentives are received by an assessee carrying on export business. So such incentives are also considered as income and hence are taxable under the head PGBP. Value of any benefit or perquisite, sum due to or received by a partner of a firm. Any sum in the way of interest, salary, bonus, commission or remuneration received by a partner of a partnership firm is considered as income under the head PGBP. Any sum whether received or receivable in cash or kind under an agreement. Any sum received under a keyman insurance policy. Fair market value of inventory on its conversion or treatment as a capital asset. When inventory is converted into capital asset, the inventory lying with the assessee is now converted into capital asset and is used by him. In such a case, the fair market value of such asset is considered as income under the head PGBP. Sum received on account of capital asset referred under section 35 AD. Any sum received on capital assets which are referred under section 35 AD, either on their sale or transfer, such sum is also considered as income and hence is taxable as per PGBP provisions. Now let us see how income is computed under the head PGBP. First, what we do is, we will take the net profit as per the books of accounts of the assessee. In his profit and loss account, whatever the profit has arrived by the assessee, that we will take as the base figure. To that, we are going to add expenses debited to statement of profit and loss account, but not allowable as per the income tax provisions. There are few expenses like depreciation as per books of accounts. It is if the depreciation as per the books of accounts is not complying with the income tax provisions. Since we have deducted such depreciation amount in the books of accounts of the assessee, now we are going to add back such expense. Any inadmissible deductions as per the income tax provisions, we have provided for such deductions in P&L account, but now we are adding back since they are inadmissible deductions as per the income tax provisions. Less expenditure allowable as deduction but not debited to statement of profit and loss account. Since we have added back the depreciation as per books of accounts to the net profit, now we will calculate the correct depreciation amount as per the income tax provisions. After calculating the depreciation as per the Income Tax Act, we are going to deduct such deduct such amount from the net profit. Less income credited in statement of profit and loss but not taxable or taxable under any other head. Any income which is not taxable or any income which is taxable under any other head. For example, rental income, it is taxable under the head house property. Interest income, it is taxable under the head other sources. We will reduce such income amount from the net profit as per the statement of profit and loss account. Then add income chargeable under this head or deemed income if the same is given as additional information and has not already been credited to statement of profit and loss account. If in question it is given that there is some deemed income or any income chargeable under this head, but the assessee has not added such income to his profit and loss account. In such a case, we will add such income in computation of income under the head PGBP. For example, remission or cessation of trading liability, any bad debt recovered, we will add back such incomes to compute the income under the head PGBP. Hence, we will arrive at a figure which is the profit and gain from the business or profession as per the income tax provisions. Following deductions are disallowed if assessee chooses to pay tax under default tax regime. Additional depreciation, deduction in respect of expenditure incurred for in-house scientific research related to the business of assessee, and contribution to outsiders for scientific research or social science or statistical research. Investment linked tax incentives for specified businesses. We will discuss these three topics one by one. So first, let us see what are the expenses which are allowed as per the income tax provisions. Starting from section 13 to section 37. These sections discuss about admissible deductions under the income tax provisions. So, we are going to deduct such expenses from the income of assessee. So, we will arrive at the profit or gain from business or profession. Let us see section 30. Rent, rates, taxes, repairs and insurance for buildings. The building should be used by the assessee for the purpose of business. Here we are talking about buildings only. Any rent, rates, taxes or repairs and insurance for such buildings are deductible as per the income tax provision, subject to few conditions. The building should be used by the assessee for the purpose of business. If the assessee is tenant, the rent paid by him and costs borne by him on repairs are deductible. If the assessee is tenant of the building, he is not the owner and he is paying rent for such building, and if any cost is incurred by the assessee, then such rent paid and costs incurred by him on repairs are deductible. This is the case where assessee is tenant, not the owner of the building. If the assessee is owner of the building, no notional rent will be allowed as deduction. he can claim the expenses incurred on repairs as a deduction. Since the assessee is the owner of the building and he is using such building for his own business, no notional rent will be allowed as the deduction. And also, he can claim the expenses incurred on repairs as a deduction. If any expenses incurred by the assessee on repairs of such building, he can claim it as a deduction. The cost of repairs should not be of capital nature. Only revenue nature repairs, cost of repairs will be deductible. Expenses by way of land revenue, local rates, municipal taxes and insurance in respect of the premises are deductible. Cesses, rates and taxes levied by foreign government are also allowed. If any cess or rates or taxes are levied by foreign government on such building, then they are also allowable as deduction. Premises used partly for business and partly for other purposes. Proportionate part of expenses will be deductible. This will be stated in section 38 also, that if the premises the building is used partly for business and partly for his personal purpose, if any expenses incurred on the building, then we will allow deduction under the head PGBP on proportionate basis. We will take proportionate amount of expenses which are incurred on the building in respect of business of the assessee, and we will deduct only such proportionate amount while computing the PGBP income. If assessee is lessee, licensee or mortgagee with possession, assessee is lessee, licensee or mortgagee and he is possessing the building, he can claim the deduction for current repairs to the premises. Only current year repairs are to be provided for, are deductible. Such expenses on such current year repairs are deductible. Now let us discuss the section 31, which is regarding machinery, plant and furniture. Repairs and insurance of machinery, plant and furniture. Conditions to claim deduction under this section are: assets must have been used for the purposes of the assessee's own business. If repairs and insurance expenses incur but assets have not been used for the business during the previous year, then such expenses are not allowed as deduction. The asset must be in use by the assessee in the previous year. If the repairs and insurance expenses are incurred but the assessee has not used such assets in his business during the previous year, then we will not deduct such expenses under the head PGBP. Repairs will include renewal or renovation of an asset, but not its replacement or reconstruction. Replacement or reconstruction are of capital nature. Hence, we will allow deduction of only those expenditure which are of revenue nature. So, renewal or renovation of an asset, it will be included under the term repair. But replacement of asset or reconstruction of asset is not of revenue nature, hence we will not allow any deduction in case of replacement or reconstruction. Repairs shall not include any capital nature expenditure. Insurance premium is deductible if it is taken against the risk of damage or destruction of the asset. Assets are used by the assessee for the purpose of business or profession during the previous year. Here we have discussed, if the repairs or insurance expenses incur but assets have not been used, we are not going to allow the deduction. The same point is given here. Assets are used by the assessee for the purpose of business or profession during the previous year. Only then, if the asset is used, the assessee can claim the insurance premium amount as deduction. The premium should have been actually paid or payable under the mercantile system of accounting. The premium should have been actually paid or under the mercantile system of accounting, it is payable. In such cases, we will allow the insurance premium as a deduction under the while computing income under the head PGBP. Let us now head to section 32 that discusses about depreciation. So we all know what the term depreciation means. It is reduction in value of asset due to usage, due to passage of time. We have just discussed before that we will add back the depreciation as per the books of accounts to the profit, the net profit as per the profit and loss account, if it does not comply with the income tax provisions. Then we will calculate the depreciation, correct depreciation as per the income tax law, and we are going to deduct such depreciation expenditure from the profit. So, what are the conditions to be satisfied for the depreciation on an asset to be claimed as per the income tax provisions? Let us discuss them. Conditions to be satisfied for allowance of depreciation are: the assets should be either tangible or intangible assets. Tangible assets include buildings, machinery, plant or furniture. Intangible assets include know-how, patents, copyrights, trademarks, licenses, franchises or any other business or commercial rights of similar nature. It does not include goodwill. The term plant under the tangible assets, it includes ships, books, vehicles, scientific apparatus and surgical equipment, goods and chattels. They can be either fixed or movable goods, and they should carry some degree of durability. It does not include tea bushes or livestock, an animal or human body or stock in trade. The term buildings includes roads, bridges, culverts, wells and tube wells. The assets should be actually used by the assessee for the purposes of his business during the previous year. Without using such assets in the business, the assessee cannot claim depreciation on such assets. Asset acquired and put to use for less than 180 days in previous year, then only 50% depreciation is allowed. This restriction is applicable only in the year of acquisition and not in subsequent years. There might be a case where assessee has acquired an asset in the previous year and such asset has been put to use for less than 180 days. That means not even 6 months approximately. In such a case, only 50% depreciation on such asset can be claimed. This condition is applicable only for the year of acquisition if the previous year is year of acquisition of such asset. For subsequent years, such condition is not applicable. If assets used by another person, lessee or licensee, assessee can still claim deduction for depreciation. No depreciation will be allowed to an assessee in respect of an asset which he does not own but only uses or hires for purposes of his business. Here, the assessee is not the owner of such asset. He only hires such asset. In such a case, depreciation on such asset cannot be claimed by the assessee. There is one more point to be noted. Assessee holds a lease or other right of occupancy, and any capital expenditure is incurred by the assessee for the purposes of business or profession, or the construction of any structure or doing of any work by way of renovation, extension or improvement to the building. Then depreciation will be allowed as if the said structure or work is a building owned by the assessee. Here the case is assessee is owning a building. Assessee is possessing a building. He is not the owner of the building. He holds a lease or other right of occupancy of such building, and any capital expenditure is incurred by the assessee. If capital expenditure such as renovation, extension, improvement or any construction of any structure is incurred by the assessee in the previous year, then the depreciation on such building will be allowed to the assessee itself, not the real owner of the building. If assessee incurs capital expenditure by way of construction of any structure, renovation, extension or improvement to the building, then he can claim the depreciation irrespective of the ownership of the building. Apart from the normal depreciation, income tax provisions also provide additional depreciation. For an assessee to claim the additional depreciation on an asset, following are the conditions. Assessee is engaged in business of manufacture or production of an article or thing, or is in business of generation, transmission or distribution of power. Here the assessee is not wholesaler or a retailer. He is manufacturer, or he is engaged in production of an article or thing. Or if the assessee is engaged in business of generation, transmission or distribution of power, not just distribution of power, here the generation, transmission or distribution of power, if he is engaged in such business, additional depreciation can be claimed by such assessee. Here the business of printing and publishing is also included under the definition of production, under the term production of an article or thing. The machinery or plant should not be ship or aircraft. To claim additional depreciation, the machinery or plant should not be ship or aircraft. Additional depreciation is not applicable on any machinery or plant which before its installation by the assessee was used within or outside India by any other person. That means second hand plant or machinery. Here before assessee has installed such plant or machinery, it has been used by some other person either in India or outside India. Then assessee cannot claim additional depreciation on such asset. Any machinery or plant installed in office premises, residential accommodation or in any guest house. The plant and machinery is not installed in the factory. It is not being used for production or manufacture of article or thing. It is installed in office premises, residential accommodation of assessee or in any guest house. In such a case, he cannot claim the additional depreciation on such asset. Office appliances or road transport vehicles. These are no way used in production of article or thing. So, he cannot claim additional depreciation. Any machinery or plant, the whole or part of the actual cost of which is allowed as deduction, whether by way of depreciation or otherwise in any PY. Already, deduction is allowed on such plant or machinery in any other section in any previous year. Then on such asset, assessee cannot claim additional depreciation. The rate of depreciation, the additional depreciation, is 20% of actual cost. We will discuss the normal rates of depreciation for each asset as we move further, but for additional depreciation, the rate will be 20% of actual cost of the asset. If the asset is put to use for less than 180 days, just like for normal depreciation, we are going to charge only 50% of depreciation. That means the additional depreciation at the rate of 10% only is charged in the previous year in which the asset is acquired. Balance additional depreciation at the rate of 10% is allowed in the immediately succeeding previous year. For additional depreciation, we have to claim 20% on the actual cost. But since the asset is put to use for less than 180 days, we are only claiming 10% depreciation in the previous year. In the immediately succeeding previous year, we can claim the other 10%, balance 10% of additional depreciation. I hope it is clear for you. Here it has been mentioned that 20% of actual cost. So what is this actual cost? What all costs does it include? Let us discuss. Actual cost is the actual cost of the asset incurred by the assessee minus portion of cost met directly or indirectly by any other person or authority. He might get subsidy for acquiring such asset. Such subsidy portion should be deducted. So, whatever the actual cost the assessee has paid to acquire such asset, from that we will deduct any cost met directly or indirectly by any other person or authority. That is the actual cost. If payment for acquisition of asset has been made to a person in a day, otherwise than by an account payee check drawn on a bank or account payee bank draft or use of electronic clearing system through a bank account or through such other prescribed electronic mode, and it exceeds rupees 10,000, such expenditure shall not form part of actual cost. Here the assessee is paying, the payment is made for acquisition of any asset, and the payment has been made to a single person in a single day. The amount is exceeding rupees 10,000, but the assessee is not paying such person through account payee check or account payee bank draft or electronic clearing system or any electronic mode. Other than these four modes, if the assessee is paying to a single person in a single day for acquiring the asset and the amount is exceeding rupees 10,000, then such expenditure shall not form part of the actual cost. So, here there are various circumstances under which the actual cost varies to the assessee. Let us discuss those cases one by one. Asset used for business after it ceases to be used for scientific research. An asset is being used for scientific research. And now, from the scientific research department, the asset is brought out. In such a case, the actual cost will be actual cost to the assessee minus any deduction allowed under section 35. Under section 35, the assessee can claim deduction for capital asset used for scientific research. So the actual cost for the assessee, if the asset is now being used for purpose other than scientific research, will be the actual cost incurred by the assessee on acquiring such asset minus any deduction allowed under the section 35. Case 2. Inventory converted into the capital asset and used for business or profession. The fair market value of such inventory as on date of its conversion into capital asset. We have discussed under the section 28 that when inventory is converted into the capital asset, it will be deemed as income of the assessee. The fair market value will be deemed as income for the assessee. So, the actual cost here will be the fair market value of such inventory as on date of its conversion into capital asset. That fair market value will be treated as actual cost incurred by the assessee to acquire the asset. Asset is acquired by way of gift or inheritance. In such a case, the actual cost is paid by the previous owner. On the acquisition of the asset, payment is made by previous owner, not the assessee. So the actual cost which has been incurred to the previous owner plus any expenditure on freight, installation, etc. incurred by the assessee. Freight, installation expenses incurred by the assessee plus actual cost to the previous owner minus depreciation allowable to the assessee as if the asset was only asset in the relevant block of assets will be the actual cost of the asset. Fourth case, second hand asset used by any other person for the purpose of his business or profession, and assessing officer is satisfied that the main purpose of the transfer was the reduction of liability of income tax. Here the asset is already used by some other person, and now the transfer of asset has taken place, and now the another assessee can this another person, the buyer of asset, can claim the depreciation. And the motive behind this transfer of second hand asset is to reduce the income tax liability. The assessing officer is also satisfied that the main purpose of the transfer was the reduction of liability of income tax. In such a case, the actual cost of such asset will be an amount which the assessing officer may, with the previous approval of the joint commissioner, determine, having regard to all the circumstances of the case. Case 5. Reacquisition of asset. Any asset which had once belonged to the assessee and used by him for the business or profession, and thereafter ceased to be his property by reason of transfer or otherwise, is reacquired by him. Once it was the property of assessee, he used it for business or profession. After that, either by transfer or any other reason, the ownership of such asset has been transferred to other person. Now the asset has been reacquired by the assessee. In such a case, the actual cost will be least of the actual cost when the assessee first acquired such asset minus depreciation allowable to the assessee as if the asset was only asset in the relevant block of assets, or the actual price for which the asset is reacquired by him. Either the actual cost incurred by the assessee when he first acquired the asset minus depreciation, or the actual price now the assessee is paying to reacquire the asset. Whichever is lower of these two is considered as the actual cost of such asset. Case 6. Acquisition of asset previously owned by any person to whom such asset is given on lease, hire or otherwise. Here, asset is given on lease or hire to some person, and that person is now acquiring the asset. The actual cost will be written down value of the said asset at the time of transfer. Building previously the property of the assessee used for the personal use, now put to use for business or profession. The building which has been used by the assessee for his personal purpose is now being used for business or profession of the assessee. In such a case, we will take the actual cost as the actual cost of the building to the assessee minus amount of depreciation, and the depreciation rates are charged and computed as if the asset has been used since its acquisition for the business or profession, not for the personal use. Since its acquisition, the asset, if it is used for business or profession, how it will be depreciated, what rates of depreciation are used. Such equal amount of depreciation will be reduced from the actual cost incurred by the assessee to arrive at net actual cost. The next case is capitalization of interest paid or payable in connection with acquisition of an asset. So generally, to acquire an asset, if the loan or any borrowing has been taken by the assessee, there will be interest chargeable on such loan or borrowing. Such interest amount should be capitalized. Such interest amount should be capitalized only till the date, time when the asset is first put to use by the assessee. Interest amount paid or payable relating to the acquisition of an asset after it is first put to use shall not be part of actual cost. Till the date when the asset is first put to use, whatever interest has been incurred, interest paid or payable, such amount we will add to the actual cost of the asset. But after the asset has been first put to use, whatever interest is paid or payable, it will not form part of the actual cost. The next case, amount of duty of excise or additional duty leviable shall be reduced if credit is claimed. So from the actual cost of the asset, the actual cost incurred on the asset, we will reduce any amount of duty of excise or additional duty in respect of which the claim of credit has been made and allowed to the assessee. Subsidy or grant or reimbursement by central government, state government or any authority. If any subsidy or grant or reimbursement is given by central government or state government or any authority, such subsidy or grant amount shall not be included in the actual cost of the asset to the assessee. Asset is acquired outside India by an assessee being a non-resident, and such asset is brought by him to India. Here the assessee is non-resident and it has been used by the assessee outside India. Now it is brought into India for his business or profession. The actual cost on such asset would be actual cost of the asset minus amount equal to the amount of depreciation, as if the depreciation is charged and we have to charge the depreciation as if the asset is used since its acquisition for business or profession in India. The depreciation rates are charged and computed as if the asset is used for the purpose of business or profession in India since its acquisition. Such depreciation amount should be reduced from actual cost of the asset to arrive at net actual cost. Capital asset on which deduction is allowed under section 35 AD. Such capital asset, the actual cost will be taken for such capital asset, the actual cost will be taken as nil. Since the deduction is already allowed under section 35 AD, we will take the actual cost as nil. So, we have discussed the conditions for charging depreciation, for conditions to be satisfied for allowance of depreciation. What are the assets and what is additional depreciation? Who is eligible to claim additional depreciation? What is the actual cost on which the depreciation is charged? What is the actual cost? After this, we will see what are the rates of depreciation for different assets. First, let us see how is depreciation charged on asset, the manner of charging depreciation. Block of assets. we will charge depreciation not on individual assets but on block of assets. What does block of asset mean? Group of assets falling within same class of assets in respect of which the same percentage of depreciation is prescribed. We will group all these assets into blocks. Instead of individuals, we will divide the assets, classify the assets based on their class as well as the rate of depreciation chargeable on such assets. We will classify them into different blocks, and on such block the depreciation is charged. Written down value method is used to charge depreciation block of assets. Not SLM basis, we will charge the depreciation under the written down value method, as per the written down value method, as per the income tax provisions. The categories of assets under the same block. We have different categories of assets like buildings, furniture and fittings, plant and machinery, ships, as well as intangible assets. Under these, there are different categories, assets which are of different categories which fall under different rates of depreciation. So for example, the first one is buildings. For buildings, for different types of buildings, the depreciation rates chargeable are 5% or 10% or 40%. 5% depreciation is charged on buildings which are used mainly for residential purposes except hotels and boarding houses. The buildings which are used for residential purposes, but they are not hotels or boarding houses. For such buildings, depreciation rate will be 5% per annum. For buildings not used mainly for residential purposes and not covered by block 1 above and block 3 below, 10% rate is chargeable. So what does block 3 say? Buildings acquired on or after 1st September 2002 and which is put to use for the purpose of business of providing infrastructure facilities. Such building is put to use for the purpose of business of providing infrastructure facilities. It is not for residential purpose. Such buildings, on such buildings we charge 40% depreciation rate. And as discussed above, the 10% category, buildings which are not used for residential purposes, which are not covered in block 3 and block 1. For such buildings, 10% depreciation rate is charged. There may be cases where some temporary erections are built. For such purely temporary erections, such as wooden structures, 40% depreciation is chargeable. So, 5% is for buildings which are used for residential purposes except hotels and boarding houses. 10% are for buildings which are not used for residential purpose and not covered in block 1 or block 3. Hotels and boarding houses can claim 10% depreciation on their buildings. 40% depreciation claimed on buildings which are put to use for the purpose of business of providing infrastructure facilities. And 40% is also claimed on buildings which are purely temporary erections. Then comes the next asset, which is furniture and fitting. For all furniture and fittings including electrical fittings, electrical wiring, switches, sockets, other fittings and fans, etc., 10% per annum depreciation is charged. The next asset is plant and machinery. Under plant and machinery, we have first motor vehicles. So, for motor cars, under the 15%, for motor vehicles we are charging depreciation at 15% or 30% or 45%. What are the differences? Let us see. 15% depreciation per annum is charged on motor cars which are acquired or put to use on or after 1st April 1990. And these are motor cars which are used for other than those used in business of running them on hire. For such motor cars, 15% rate of depreciation is charged. For motor cars other than those used in business of running them on hire, acquired during the period from 23rd August 2019 to 31st March 2020 and put to use on or before 31st March 2020, 30% depreciation is charged. Here we are talking only about motor cars. The first category is 15%, the second category is 30%. Under the first category, the motor cars are put to use are those motor cars other than those used in business of running them on hire, and they are put to use on or after 1st April 1990. On them, 15% rate of depreciation is charged. For motor cars other than those used in business of running them on hire acquired during the period from 23rd August 2019 to 31st March 2020 and put to use on or before 31st March 2020, 30% depreciation is charged. Now let us discuss about motor buses, motor lorries, motor taxis used in the business of running them on hire. They are used in the business of running them on hire. Depreciation chargeable is 30%. But if such motor buses, motor lorries or motor taxis used in business of running them on hire are acquired during the period from 23rd August 2019 to 31st March 2020 and are put to use on or before 31st March 2020, the depreciation rate will be 45%. I hope it is clear for you. Now let us discuss about other assets which are covered under the block plant and machinery. General rate of depreciation for plant and machinery is 15%. Also, for windmills and any specially designed devices running on windmills like electric generators and pumps running on wind energy installed on or before 31st March 2024, 15% depreciation is chargeable. General rate of depreciation for plant and machinery is 15%, and also for windmills and any specially designed devices running on windmills. If they are installed on or before 31st March 2024, 15% rate of depreciation is charged. Then comes 30% category. 30% depreciation is chargeable on molds used in rubber and plastic goods factories. Also, plant and machinery used in semiconductor industry covering all integrated circuits, ICs. For these two assets, 30% depreciation is charged per annum. Next comes 40% category, plant and machineries. For aeroplanes, aero engines, 40% rate of depreciation is charged. Similarly, for any specified air or water pollution control equipments, solid waste control equipment and solid waste recycling and resource recovery systems, 40% depreciation rate. Machinery and plant acquired and installed on or after 1st September 2002 in a water supply project or a water treatment system and which is put to use for the purpose of business of providing infrastructure facility. Here, remember one point, we are focusing more on the equipment which is used in either controlling the air or water pollution, or these equipment, the plant and machinery, are used in any water supply project or water treatment system. These equipment are either used in control of pollution or solid waste management or water treatment or water supply project, energy saving devices, renewable energy saving devices. All these equipment are under the category of 40% depreciation rate. The energy saving devices also, on such devices also 40% depreciation is charged. Renewable energy saving devices as specified, including electrically operated vehicles including battery powered or fuel cell powered vehicles. Windmills and any specially designed devices which run on windmills installed on or after 1st April 2014. Any special devices including electric generators and pumps running on wind energy installed on or after 1st April 2024. If it is before 1st April 2024, here we charge 15%. If they are installed on or after 1st April 2024, we charge 40% depreciation rate on such windmills or any special devices which are running on wind energy. Containers made of glass or plastic used as refills. Life-saving medical equipment. These two also carry 40% rate of depreciation. Computers including computer software. Books which include annual publications or other than annual publications. Owned by assessees carrying on a profession. Books owned by the assessees carrying on business in running lending libraries. So computers, computer software, books, including annual publications or other than annual publications, the assessee might be either carrying on a profession or he is running a library. For all these assets, 40% depreciation is charged. The next block of asset is ships. For all kinds of ships, ocean-going ships, vessels ordinarily operating on inland waters, speedboats operating on inland waters, they carry 20% rate of depreciation. And for all the intangible assets, the next block is intangible assets, and for all intangible assets including know-how, patents, copyright, trademark, licenses, franchises or any other business or commercial rights of similar nature, not being goodwill of a business or profession, 25% rate of depreciation is chargeable. We know that on goodwill there is no depreciation charged. So not being goodwill, all the other intangible assets carry 25% rate of depreciation. So these are the rates of depreciation for different assets. Now let us discuss what does written down value mean. How to compute depreciation, we'll see. So we know that all the block of assets are depreciated as per the written down value method. Under the written down value method, once the depreciation is charged, the balance amount of asset is called as written down value. That value of asset after the charge of depreciation is called written down value. Computation of written down value, thereby depreciation, is as follows. In the first step, written down value of the block of asset in immediately preceding previous year is taken. To such amount, we are reducing depreciation actually allowed for that block of asset in the said preceding previous year. First, we are taking opening WDV of the block of assets in immediately preceding previous year. And whatever depreciation is chargeable for such year, we are reducing such amount. We will get opening balance of WDV for the current previous year. To that, we are going to add any actual cost of assets acquired during the previous year. In previous year, whatever assets we have acquired, the actual cost of such assets will be added. On such total amount, we are going to reduce any money which is received or receivable in respect of any asset which has been sold, discarded, demolished or destroyed during the previous year, together with the scrap value. However, such amount cannot exceed the amount in fourth step, the total amount in the fourth step. So, after reducing such money receivable on sale, on asset being discarded, demolished or destroyed, together with the scrap value, we will arrive at WDV at the end of year for the charge of depreciation. Now, the WDV at the end of the year of the block of asset is, we have arrived at such figure. On such figure, we are going to charge the depreciation. Depreciation at the prescribed rate, that means the rate of depreciation into WDV arrived above. That amount should be reduced to arrive at written down value of the block of asset at the end of the year. We will take each block of asset to which the same rate of depreciation is chargeable. All the buildings falling under the category of 10%, all the plant and machinery which fall under 15% rate of depreciation category, which are of similar nature, similar class, all the motor cars which carry the depreciation rate at 15%. We are going to classify such all the assets into such blocks, and then we are going to calculate the written down value at the end of the year for the charge of depreciation. On such written down value, we will first calculate the depreciation. On reducing such depreciation amount, we will arrive at the written down value of the block of asset at the end of the year. Written down value can be nil when monies received by the assessee on sale of assets is greater than WDV. Here we have discussed one point. In the fifth point, it is mentioned that however such amount cannot exceed the amount in 4. Here the written down value of the block of asset, let us say, is 100. On sale of any asset, the assessee is gaining 120 rupees. In such a case, the WDV is less than the money received on sale of asset. So we will take WDV as nil in such cases when the monies received by the assessee on sale of asset is greater than the written down value itself. All the assets in the relevant block may be transferred during the year. When all the assets which are in a relevant block are transferred during the year, then there will be no asset in the block, and hence the WDV will be nil. Written down value will be nil. Order of set off of losses. First, when we have to set off depreciation or any losses from the income, we will give first priority to current year depreciation. Current year depreciation should be reduced from income from profits and gains from business or profession of the assessee. After deducting current year depreciation, we will deduct brought forward losses if any, and then unabsorbed depreciation. If there is depreciation which has been in any let us take example for example in any previous year, the income is less and the depreciation amount is more. In such a case, the depreciation will be set off to the extent of the income of the assessee. Such unabsorbed depreciation portion will be carried forward to the next years, and while setting off, we are going to deduct such unabsorbed depreciation in the previous year from the income of the previous year. With this, we have discussed what does written down value mean and how to calculate depreciation. Now let us head to the next topic, that is units engaged in generation and distribution of power. So for any unit which is engaged in generation and distribution of power, it can claim depreciation on its assets under SLM basis. Generally, WDV method is used for charging depreciation on assets as per the income tax provisions. But there is an exceptional case in case of units which are engaged in generation and distribution of power, not just distribution of power. The unit should also be engaged in generation of power. It has an option to choose to charge depreciation under the WDV method, but the option will be irrevocable. Once it has chosen to depreciate as per WDV method, it cannot go back and revoke such option. In such a case, when depreciation is charged as per SLM by such units and such asset is sold, there are two cases which might arise. The first case is the sale price is less than WDV of such asset. It means there is a loss. The written down value of asset is more than the sale price, the money received on sale of such asset. In such a case, there will be loss. Whatever difference between the written down value of the asset and the sale price is there, we will treat it as terminal depreciation. Here the asset is being sold. Hence, the loss on sale of such asset will be treated as terminal depreciation and will be allowed as expenditure under the head PGBP. Generally, such terminal depreciation concept will not arrive in accounting when the books of accounts are prepared. But as per the income tax provision, hence terminal depreciation is not shown in profit and loss account which is made by the accountant. Such terminal depreciation is arrived only when it is calculated in as per the income tax provisions, and hence this is allowed as deduction. This is allowed as expenditure under the head PGBP. The loss amount is allowed as expenditure under the PGBP. The second case is the sale price is greater than WDV of such asset. In such a case, there is a term called balancing charge. The balancing charge is consider it as a profit. Balancing charge is equal to aggregate of monies payable minus WDV. Whatever money is received on sale of such asset minus WDV is balancing charge, and such amount is taxable under the head PGBP. Terminal depreciation is allowed as expenditure under head PGBP. Balancing charge is taxable under the head PGBP since it is deemed as income. But here the case is whatever the money is received by the assessee on sale of such asset is exceeding the actual cost of assessee. In such a case, the difference amount between money received by the assessee, money is payable on the sale minus actual cost, is taxable under the head capital gains. To make it clear for you, there is a small example. The actual cost incurred by the assessee on acquisition of the asset is 100. The money payable on sale of such asset is 120. Return on value of such asset in the year of sale is 70. In such a case, amount taxable under the head capital gains will be 120, that is money received minus actual cost 100, which is equal to 20 rupees. And balancing charge, which is taxable under the head PGBP, will be 120 minus 70 minus 20. That is the difference between WDV and actual cost. That is the balancing charge, rupees 30. The tax shall be levied in the year in which the monies payable become due. These provisions will apply as if the business is in existence in that previous year, even if the business has ceased its existence in such previous year. The business is not running, it has been seized, but the assets are still lying in the factory. Now the sale of assets is being made. So whenever on sale of such assets, the monies payable becomes due to the assessee. In such previous year, the tax shall be levied on any balancing charge, as if the business is still running, is still in existence. With this, we have completed section 32. Now let us head to section 35, that is expenditure on scientific research. So, section 35 allows any expenditure on scientific research as deduction under the head PGBP. It can be deducted from the income under the head PGBP. The expenditure should have been incurred on scientific research by the assessee. Either it should be related to assessee's business, or the assessee should have paid the amount or contributed for scientific research in following four ways. Let us discuss the first case where the expenditure incurred on scientific research is related to the assessee's business. First case, prior to the commencement of business, if the assessee has incurred any expenditure on the scientific research related to his business, which has not yet commenced. So, any revenue expenditure incurred, like payment of salaries to research personnel, or for purchase of material inputs which are used in the research, for the 3 years immediately preceding the commencement of business. That means we have to go back from the date of commencement of business, we have to go back for 3 years. And in these 3 years, if any revenue expenditure is incurred by way of salary given by the assessee for scientific research personnel, or any material input purchased by assessee for such scientific research, such revenue expenditure can be claimed as deduction. It is allowable as deduction. And capital expenditure incurred by the assessee other than on land is also considered as expenditure, and hence we deduct such amount from income under the head PGBP. Deduction is allowed in previous year in which the business has commenced, limited to the amount specified by the prescribed authority, subject to limits prescribed by the prescribed authority. The deduction on such revenue expenditure and capital expenditure incurred on other than land is allowed as deduction. Here, the capital expenditure should not have been incurred on land. Any capital expenditure incurred on land is not allowed as deduction under section 35. Since the business has not yet commenced, for these 3 years we are not going to claim any deduction. But in the previous year in which the business has commenced, for the previous 3 years, whatever the for the years immediately preceding the previous year, whatever revenue expenditure or capital expenditure has incurred by the assessee, we can claim as the deduction in the year of commencement, in the previous year in which the business has commenced. I hope it is clear. Now let us head to the next concept, that is after the commencement of business. If the expenditure is incurred after the commencement of business of the assessee, the expenditure, revenue or of capital nature other than the cost of acquisition of land on scientific research for in-house research related to its business is allowable as deduction in the previous year in which it has incurred. After the commencement of assessee business, any revenue or capital expenditure other than on land incurred for the purpose of scientific research for in-house scientific research, and such research is related to the business of assessee. Such expenditure will be allowed as deduction in the previous year in which it has incurred. There is a point to be noted. Any unabsorbed capital expenditure, the expenditure which could not be set off against business profits in the preceding years on the scientific research, can be carried forward indefinitely for set off against any income of assessee other than salaries. Assessee has incurred any capital expenditure in preceding years regarding the scientific research, and the profits which are earned by the assessee are not enough to set off the expenditure incurred on such capital asset. The unabsorbed capital expenditure portion, whichever is left out balance, it can be carried forward indefinitely, infinitely for the coming years, and it can be set off against any income of the assessee other than salary income. You cannot set off such unabsorbed capital expenditure against the salary income of the assessee. Next point. No depreciation will be admissible on any capital asset represented by expenditure which has been allowed as deduction under section 35 in any previous year. We have already gone through this point. While discussing the actual cost of different assets, the capital asset on which deduction is allowable under section 35 AD, for that asset we will take actual cost as nil. When the actual cost is nil, you cannot claim depreciation for such an asset. Once any deduction is made available to any asset under section 35, for such asset the actual cost is taken as nil, and hence there will be no depreciation chargeable on such capital asset under section 32. I hope it is clear. Sale of asset representing expenditure on capital nature on scientific research. Lower of amount of sale proceeds or deduction allowed under section 35 will be charged to tax as income of the business in the previous year in which the asset is sold. If you remember, while discussing the incomes, while discussing section 28, we have come across this point. Sum received on account of capital asset referred under section 35 AD. So, when the asset which is used for scientific research, it is of any such asset is now being sold, the sale proceeds or deduction allowed under section 35, whichever is lower, will be treated as the income for the purpose of taxation in the previous year in which such asset is sold. These are the points related to in-house research. Now let us see how assessee can claim depreciation incurred by him on scientific research which is not in-house. That means the research, scientific research, is not related to assessee's business, but he has paid an amount or contributed some amount towards the scientific research to following 4 institutes. The first is approved Indian company for scientific research. The assessee is paying amount or contributing some amount to an approved Indian company for scientific research, or to a notified approved university or college or research association or other institution for social science or statistical research, or for notified approved university or college or research association or other institution for scientific research, or for any approved national laboratory, university or IIT or specified person for scientific research undertaken under an approved program. When assessee contributes or pays amounts to such institutes towards such research, 100% deduction in respect of such expenditure is allowed. That means from the income under the head profits or gains, we will reduce such amount contributed or paid by the assessee. 100% of such amount can be claimed as deduction. Deduction under section 35 is allowed only when assessee opts out of default tax regime and pays tax under optional tax regime. I should have mentioned this point before. The additional depreciation can be also claimed by assessee only if he opts out of the default tax regime. Here it is. The additional depreciation and deduction in respect of expenditure incurred for in-house scientific research related to business of the assessee and contribution to outsiders for scientific research or social science or statistical research. That is expenditure incurred under section expenditure which is allowed as deduction under section 35. And additional depreciation. These both cannot be claimed as deduction. These are disallowed under default tax regime. Only if the assessee chooses to pay tax under optional tax regime, these deductions are allowed. Under default tax regime, these are disallowed. Heading to the next section, section 35 AD. Investment linked tax incentives for specified businesses. Here, tax incentives are provided for investing in few specified businesses. So, what are the specified businesses? First, let us see the list. For you to easily remember, I have given the code Fabrics Shinchan. Fabrics Shinchan. F stands for production of fertilizers. A stands for warehouse for agricultural produce. B, beekeeping. R, redevelopment of slum housing. I or C, for inland container depot or custom freight station. Warehouse for sugar storage S stands for warehouse for sugar storage. So fabrics means production of fertilizers, warehouse for agricultural produce, beekeeping, redevelopment of slum housing, inland container depot or custom freight station, warehouse for sugar storage. Shinchan. S stands for semiconductor water fabrication. H for hospital with 100 beds or more. I stands for iron ore slurry pipeline. N stands for new infrastructure facility. C stands for cold chain facility or cold storage. H stands for hotel which is 2-star or above. A stands for affordable housing scheme and N stands for cross country natural gas pipeline. I hope it will be easy for you guys to remember this list of specified businesses. So when the assessee invests in such specified businesses, there will be few tax incentives. But to avail of such tax incentives, first the assessee has to meet few conditions. 100% of capital expenditure except on land, goodwill or financial instruments incurred during the previous year wholly and exclusively for the above businesses would be allowed as deduction from the business income to the assessee. So any sort of capital expenditure incurred on such specified businesses in previous year except for expenditure on land, goodwill or financial instruments, such capital expenditure will be allowed as deduction. Any expenditure in respect of which payment or aggregate of payment made to a person of an amount exceeding rupees 10,000 in a day, otherwise than by an account, pay check drawn on bank, account payee bank draft or use of electronic clearing system through bank account or through such other prescribed electronic mode would not be eligible for deduction. If the expenditure incurred is paid to a single person in a single day, otherwise than these 4 prescribed modes, and the amount is exceeding rupees 10,000, then it is ineligible for claiming deduction. Such expenditure will be ineligible for claiming deduction. The assessee cannot claim deduction. In case of an individual, or HUF or AOP or BOI, body of individuals, carrying on specified business, deduction under section 35 AD would be available only if they exercise the option of shifting out of the default tax regime. So, if the individual or HUF or AOP or body of individuals are carrying on specified businesses, deduction under 35 AD will be available only if they pay tax under optional tax regime. They opt out of default tax regime. Now let us discuss the case where expenditure has incurred by the assessee regarding the specified businesses before the commencement of such business. The business has not yet commenced, but the assessee has incurred some expenditure prior to the commencement of such specified businesses. In such a case, the expenditure will be allowed as deduction during the previous year in which the assessee commences the operation of a specified business. In the year of commencement, any prior period expenses will be allowed as deduction. The amount incurred prior to commencement of business should be capitalized in the books of account of the assessee on the date of commencement of its operations. Conditions for specified business for claiming deduction under section 35 AD. What are the conditions for the assessee to claim deduction for expenditure incurred for the specified businesses? It should not be set up by splitting up or reconstruction of a business already in existence. The new business, the specified business, should not be set up by splitting up or reconstruction of a business which is already in existence. It should not be set up by transfer to specified business of machinery or plant previously used for any other purpose. And if the transfer has taken place, the total value of the plant or machinery so transferred should not exceed 20% of the value of total plant or machinery used in the specified business. Out of the total plant and machinery used in specified businesses, such transferred assets should be only 20%. It should not exceed 20% of value of total assets. The value of the assets so transferred, the plant or machinery so transferred from other business should not exceed 20% of value of the total plant or machinery used in the specified business. The third condition: if plant and machinery are used outside India and not used in India prior to the installation by assessee, it was imported into India from a foreign country, and no deduction on account of depreciation in respect of such plant or machinery has been allowed to any person at any time prior to the date of installation by the assessee. In such a case, even if it is used outside India, if it is not used in India, it was imported from the foreign country and no deduction of depreciation has been claimed before the installation by assessee, such plant and machinery, such expenditure incurred on such plant and machinery can be claimed as deduction. The loss of an assessee claiming deduction under section 35 AD in respect of a specified business can be set off against the profit of another specified business, irrespective of whether the latter is eligible for deduction under section 35 AD. If there is an income from one specified business and loss from another specified business, this loss can be set off against the income of such another specified business only. Audit of accounts by a chartered accountant and the assessee should furnish the audit report in the prescribed form duly signed and verified by such accountant. The audit of accounts should be conducted by the chartered accountant, and the assessee should furnish the audit report in prescribed form duly signed and verified by such chartered accountant. Asset demolished, destroyed, discarded or transferred for which a deduction has been allowed, the sum received or receivable on same is chargeable to tax. So any expenditure on such assets is claimed as deduction. Any expenditure incurred on capital assets is claimed as deduction under section 35 AD. Now such asset is being demolished, destroyed, discarded or transferred, and some money is receivable. Such sum received or receivable on such transfer is chargeable to tax. Asset to be used for specified business for 8 years. If the asset is used for any other business other than specified business during these 8 years, the total amount of deduction so claimed and allowed in any previous year minus depreciation allowable shall be deemed to be the income of assessee chargeable under the head PGBP. Here, the asset which is meant for specified business should be kept in use for the purpose of specified business only for 8 years. If anywhere between these 8 years the asset is used for the purpose other than for the specified business, in such a case it is deemed that The asset is being transferred from the specified business department to other department, and on such transfer there will be certainly income. What is the income? Deemed income means the total amount of deduction which has been previously claimed by assessee under section 35 AD. From such amount we are going to deduct depreciation allowable for all these years. Whatever value is arrived, that will be deemed as income under the head PGBP for the assessee. Hence it is taxable. I hope it is clear. Now let us head to the next section, section 35D. Before we go to section 35D, once again I am making it clear for you guys. The additional depreciation, expenditure incurred for scientific research under section 35 AD, and expenditure incurred for specified businesses under section 35 AD. Expenditure for scientific research under section 35 and expenditure for specified business under section 35 AD. And additional depreciation. These three can be claimed as deduction only under optional tax regime. If the assessee opts out of default tax regime, he can claim deduction. If assessee is paying tax under default tax regime, he cannot claim any deduction for additional depreciation or under section 35 for scientific research or under section 35 AD for expenditure incurred on specified businesses. Now let us head to section 35D. Amortization of preliminary expenses. The amortization is applicable only for Indian companies when preliminary expenses are incurred by Indian companies or resident non-corporate assessees. Indian companies or resident non-corporate assessees, that means assessees other than companies. This section 35D deduction will be applicable. Expenses, preliminary expenses can be amortized only by Indian companies or resident non-corporate assessees. The amount of deduction will be 1/5 of eligible amount is allowed in 5 consecutive years. What is the eligible amount? Let us see. Least of actual notified expenses or 5% of cost of project is the eligible amount. Either the actual notified expenses or the 5% of cost of project, whichever is lower, is the eligible amount for resident non-corporate assessees. But for companies, the eligible amount will be either actual notified expenses incurred or higher of 5% cost of project or 5% of capital employed. 5% of cost of project or 5% of capital employed, whichever is higher when compared to actual notified expenses. The lower of these both, A and B, will be taken as eligible amount, and out of such eligible amount we will claim only 1/5 of amount as deduction. In the next year we will claim one more 1/5. In the next year one more 1/5 amount. That means for 5 consecutive years equal amount of deduction is claimed in respect of amortization of preliminary expenses. Assessee is a person other than a company or cooperative society. The deduction would be allowable only if the accounts of assessee for the year or years in which the expenditure is incurred have been audited by the chartered accountant. If the assessee is not a company, if the assessee is not a cooperative society, for other than companies and cooperative societies, only if the accounts of assessee for the years in which such expenditure has been incurred has been audited by the chartered accountant, the deduction can be claimed. Section 35 DDA, the next section, which states amortization of expenditure incurred under voluntary retirement scheme. It is applicable to assessee who has incurred expenditure in any previous year in the form of payment of any employee, payment to any employee in connection with his voluntary retirement. The assessee's employee is retiring, and for such voluntary retirement, the assessee is paying any expenditure to such employee. The amount of deduction will be 1/5 of amount paid for the previous year, and the balance in 4 equal installments in the 4 immediately succeeding previous years. Equal amount of deduction 1/5, 1/5, 1/5, like that for 5 consecutive years. The amount of deduction can be claimed in respect of expenditure incurred under voluntary retirement scheme by the assessee who has incurred such expenditure in any previous year for the payment to his employee in connection with his voluntary retirement. I hope it is clear for you. Now let us head to the section 36, that is other deductions. Now let us head to the next topic, section 36, which talks about other deductions. The first one is insurance premium paid for policy taken against risk, damage or destruction of stock or stores used for business or profession. In the business or profession, any insurance policy taken for the stock or stores and premium paid on such insurance will be allowed as deduction. Premium paid by employer for health insurance of employees by any mode other than cash. If it is paid in cash, the premium paid by employer for health insurance of employees will be not allowed as deduction. But if it is paid in any other mode than cash, such premium amount will be allowed as deduction for the employer assessee. Bonus and commission, if it is not a substitute for payment of dividend or profits payable. Interest on borrowing for acquisition of new capital asset for business or profession. When assessee acquires a capital asset for business or profession by taking any borrowing, the interest amount paid on such borrowing will be allowed as deduction after the asset is first put to use. From the date of borrowing to the asset when it is first put to use, whatever interest amount has been incurred on such borrowing, it will be capitalized. That means it is included in the actual cost. But after the asset is first put to use, any interest amount on such borrowing will be allowed as deduction from the business income. Discount on zero coupon bonds. Amount received on issue of the bond minus amount payable on maturity or redemption. Such difference amount will be allowed as deduction. Employer's contribution to employees recognized provident fund or approved superannuation fund. Employer's contribution to the account of the employee under a pension scheme referred to in section 80 CCD. These two contributions made by the employer to the account of employee will be allowed as deduction. Amount received by an assessee employer as contribution from his employees towards their welfare fund, to be allowed only if such amount is credited on or before the due date. The date by which the assessee is required as an employer to credit such contribution to the employee's account. Whenever the employer, being an assessee, receives any amount from his employees towards as a contribution towards the employee's welfare fund, such amount will be allowed as deduction from the business income only if it is credited to the account on or before the due date. The due date will be the date by which the assessee, the employer, is supposed to credit such contribution into the employee's account. Bad debts. Debts or loans should be in respect of a business which was carried on by the assessee during the relevant previous year. The bad debts should be related to the business of the assessee which has been carried out by him during the relevant previous year, and the bad debt is written off or the debt is written off or of an earlier previous year, or should represent money lent by the assessee in the ordinary course of his business of banking or money lending. Here the money should have been lent by the assessee in his ordinary course of business, and such debt lent out is not recoverable. In such a case, the bad debt will be written off, and such written off bad debt amount will be allowed as a deduction. Expenses on family planning by a company. This deduction is allowable only for companies, and the expense on family planning, if it is incurred by a company, is in revenue nature. It is allowed as deduction in computing the company's business income. It is allowed as deduction from the company's business income. But if such expense incurred is of capital nature, then 1/5 of such expenditure will be deducted in the previous year in which it was incurred, and in each of the 4 immediately succeeding previous years. So for 5 consecutive years, 1/5, 1/5, 1/5 of such amount will be allowed as deduction if the expense incurred is of capital nature. Deduction of securities transaction tax paid. STT paid will be allowed as deduction. Deduction for commodities transaction tax paid in respect of taxable commodities transactions. So STT and CTT paid by the assessee will be allowed as deduction from his business income. So having completed section 36, now let us discuss section 37, which talks about residuary expenses. So starting from section 30 to section 37, we have discussed about all the expenses which are allowed as deduction and the conditions for such expenses to be allowed as deduction. Section 37 talks about residuary expenses. Any expenses which are not described from section 30 to 36 are discussed here. Revenue expenditure incurred for the purposes of carrying on business or profession, not be of the nature described in section 30 to 36. Such residuary expenses are incurred by the assessee in the accounting year in respect of a business carried on by the assessee after the business has been set up, not any personal expenses of the assessee. Expended wholly and exclusively for the purpose of such business, not be in the nature of capital expenditure, and not have been incurred by the assessee for any purpose which is an offence or is prohibited by the law. Not the business losses, for example those arising out of embezzlement, theft, destruction of assets, misappropriation by employees, etc. So what is the nature of these residuary expenses? Any expenditure which is of revenue nature and not of capital nature, which is not discussed from section 30 to 36, and it should have been incurred by the assessee in course of his business in the accounting year. It should not be assessee's personal expenditure, and it should have been incurred wholly and exclusively for the purpose of such business. It should not have been incurred by the assessee for any purpose which is an offence or is prohibited by the law. And residuary expenses does not mean any business loss. Also, any expenditure incurred on keyman insurance policy is deductible. And at the same time, corporate social responsibility expenditure is not allowed as a deduction from the business income of the assessee. A taxpayer would not be entitled to any deduction in respect of expenses incurred by him on advertisement in any souvenir, brochure, tract or the like published by any political party, whether it is registered with the Election Commission of India or not. So if any political party publishes any brochure and assessee is advertising about his business in such brochure, then the expenses incurred on such advertisement will not be allowed as deduction from the business income. So with this, we have completed discussing all the expenditures from the business income which are allowed as per the income tax provisions. Section 38 talks about proportionate expenses, like if any asset is being used for both the business and personal purpose, any expenditure incurred on such asset will be proportionately divided, and the proportionate amount which is attributable towards the business or profession will be allowed as deduction from the business income. Now let us head to the next section, section 40. Inadmissible deductions. That means deductions which are not allowed from the business income. So the first inadmissible deduction is any interest, royalty, fee for technical services which is payable outside India or to a non-resident, on which TDS is deductible. If TDS has not been deducted, or TDS deducted and not paid on or before the due date specified under section 139(1). When the TDS which should have been deducted is either not deducted, or in second case it has been deducted by the payer, but it has been not been deposited before the due date. In such a case, the expense incurred in the way of such interest, royalty or fee for technical services will not be allowed as deduction. But in any subsequent year, if such tax has been deducted or has been deducted in the previous year but paid in subsequent year after the due date specified under section 139(1), Such sum shall be allowed as deduction in computing the income of previous year in which such tax is paid. In the year in which such TDS has been paid, in such year the deduction will be allowable in respect of any interest, royalty, fee for technical services which is payable outside India or to a non-resident. The second one is 30% of any sum payable to a resident on which tax is deductible at source. In the previous case, it is payable to either non-resident or it is payable outside India. In present case, any sum payable to a resident on which tax is deductible at source, but the TDS has not been deducted, or the TDS deducted not paid on or before the due date specified under section 139(1). In such a case, 30% of such sum payable will be disallowed as a deduction. It is inadmissible as a deduction. However, in any subsequent year, if such tax has been deducted or has been deducted in previous year but paid in the subsequent year after the due date specified under section 139(1), such 30% of sum payable which has been disallowed as a deduction will now be allowed as a deduction in computing the income of the previous year in which such tax is paid. Whenever the tax is paid, such 30% of amount which has been not claimed as deduction will now be allowed to be claimed as a deduction. Any sum paid on account of income tax including surcharge or cess cannot be claimed as deduction from business income. Any payment chargeable under the head salaries if it is payable outside India or to a non-resident, and if TDS has not been paid or deducted therefrom. Similar to the above cases, any payment chargeable under the head salary, if salary is payable either to a non-resident or any person outside India, and TDS has not been paid or deducted from such salary amount, it will be disallowed as a deduction. Any contribution to a provident fund or the fund established for the benefit of the employees of the assessee, unless the assessee has made effective arrangements to make sure that tax shall be deducted at source from payments made from the fund which are chargeable to tax under the head salaries. Only if arrangement has been made for TDS by the assessee from the payments made to the fund, provident fund or fund established for the benefit of the employees. In such a case only, employer contribution, the assessee's contribution will be allowed as deduction, otherwise it will be disallowed. Payment of tax on non-monetary perquisites by an employer on behalf of employee will be exempt for the employee, but will not be allowable as deduction in the hands of employer. Payment of tax on non-monetary perquisites by employer will be taxable as in the hands of employer. It will not be allowed as deduction, but for employee it will be exempt. Now let us head to the next section, section 40A. It deals with any expense or any payment which is not deductible in certain circumstances. So, expenses or payments not deductible in certain circumstances. They are, the first one is any expenditure incurred in respect of which a payment is made to a related person or entity, and it is considered excessive or unreasonable by the assessing officer. When assessing officer finds that any expenditure incurred or any payment made to a related person or entity is excessive or unreasonable, then such expense or payment will not be deductible from business income. The amount disallowed will be expense incurred minus fair market value. And the related person for different assessees are as follows. For individual, spouse, brother, sister, any lineal ascendant or descendant of the individual. That means either parents or children of the individual. For firms, the related persons will be any partner of the firm or relative of such partner. For HUF or associate of persons, any member of AOP or HUF or any relative of such member. In case of company, the director of the company or any relative of the director. And for any assessee, Related person means any individual who has substantial interest. That means 20% or more voting power or beneficial entitlement to 20% of profits. Either 20% or more voting power or beneficial entitlement to 20% of profits is considered to be substantial interest. And any individual who has substantial interest in the business or profession of the assessee or relative of such individual is considered as a related person for any assessee. The second expense. Any expenditure in respect of which a payment or aggregate of payments made to a person in a single day, otherwise than by an account payee check or account payee bank draft or ECS through bank account or through such other prescribed electronic mode exceeds rupees 10,000. We have discussed this before too. If any expenditure or payment is made to a single person in a single day, otherwise than by these four modes, and such expense or payment exceeds rupees 10,000, it will be disallowed as a deduction. Payments made to transport operator for plying, hiring or leasing goods carriages, an enhanced limit of rupees 35,000 shall apply. For payment made to any transport operator for plying, hiring or leasing goods carriages, instead of 10,000, the limit will be rupees 35,000. If the payment or payments exceed this limit, the entire expenditure will be disallowed. Not the excess amount, but the whole expenditure incurred or the whole payment which has been made will be disallowed as a deduction from the business income. There are few exceptions to this section. Even if the amount exceeds rupees 10,000 or 35,000 as the case may be, it will be allowed as deduction from business income in following cases. Payment to RBI, SBI or any cooperative bank. Payment made to government which according to its rules has to be made in legal tender, that means in cash, where the payment is made for the purchase of products manufactured or processed without the aid of power. When products made are manufactured or processed without any aid of power, in such a case, payment made to such manufacturer can exceed rupees 10,000 and it will be allowed as deduction even if it exceeds rupees 10,000. Where the payment is made in a village or town where banking services are not available, in such a case the payment cannot be made in these four modes, and in such cases, even if the payment made exceeds rupees 10,000 and the payment is made in any other mode, it will be allowed as a deduction. Where any payment is made to an employee or the heir of such employee on retirement, retrenchment, resignation, discharge or death of such employee on account of any terminal benefit, and the aggregate of such sums payable to employee or his heir does not exceed rupees 50,000. Here the amount should not exceed rupees 50,000 if it is paid in any other mode than the above four prescribed modes. The case is the payment is made to the employee or his heir on termination from the employment, retirement, retrenchment, resignation or discharge or death of such employee is the case, and the payment is made either to the employee himself or to his heir. In such a case, the amount should not exceed rupees 50,000 if the payment is made in above four, made other than the above four modes. Where the payment is made by any person to his agent who purchases goods or services on behalf of such person for cash. Where the payment is made by an authorized dealer or a money changer against purchase of foreign currency or travelers' checks in the normal course of his business. Salary paid to employee who is temporarily posted at some other place for 15 days or more, where such employee does not have a bank account. The payment made by way of book adjustments. Payment for purchase of agricultural produce, forest produce, fish and fish products, productions of horticulture or apiculture to the cultivator, grower or producer of such produce or products. So when payment is made in these cases by other than these four modes and it is exceeding rupees 10,000, in such a cases deduction will be allowed even when the amount is exceeding rupees 10,000 and payment is made to a person in a single day. These are exceptions to section 40A(3). Coming to the next section, provision for payment of gratuity to employees. Disallowance, any provision for payment of gratuity to employees is disallowed as a deduction. However, disallowance would not be attracted if provision is made for contribution to approved gratuity fund or for the payment of gratuity that has become payable during the year. Also, any payment made to non-statutory funds will be disallowed as a deduction. No deduction will be allowed where the assessee pays in his capacity as an employer any sum towards setting up or formation of or as a contribution to any fund, trust, company, association of persons, body of individuals, society or other institution for any purpose. So heading to the next section, section 41, which deals about profits chargeable to tax. Till now, from section 30 to 37, we have learnt about admissible deductions, the deductions which are allowed. Section 40 deals about inadmissible deductions. And now section 41 talks about profits, that means income, which is chargeable to tax. The first one is where deduction was allowed in respect of loss, expenditure or trading liability for any year. Subsequently, during any previous year, the assessee or successor of the business has obtained any amount in respect of such loss or expenditure. The amount so obtained or the value of benefit accrued shall be deemed to be income of the previous year in which such benefit was obtained. Here, for any loss, expenditure or trading liability, the deduction was allowed in preceding years. And subsequently, during any previous year, the assessee or the assessee's successor in business has obtained any amount in respect of such loss or expenditure. The amount so obtained or the benefit will be deemed to be income of the previous year and it will be taxable. The second case, amount realized on transfer of an asset used for scientific research without being used for other purposes is taxable as a business income. The taxable amount is lower of deduction allowed under section 35 or sale proceeds. The asset which has been used for scientific research, on that deduction is allowable. And now such asset is being sold. The taxable amount will be, on such sale, the taxable amount will be lower of either deduction allowed under section 35 or the sale proceeds. Out of the deduction allowed under section 35 or sale proceeds, whichever is lower will be considered as taxable amount on sale of asset used for scientific research. The third point, any amount recovered by the assessee against bad debt earlier allowed as deduction shall be taxed as income in the year in which it is received. In preceding years, a bad debt has been allowed, a deduction has been allowed on any bad debt, and now the assessee is recovering some amount from such bad debt. So, such amount which has been recovered will be taxable in the previous year in which it is received. Balancing charge on sale by power generation units. On sale of assets by power generation units, if the sale proceeds are more than the WDV or actual cost, balancing charge will arise. Such balancing charge is considered as a profit and will be taxable under the head PGBP. Heading to the next section, section 43B, which deals about deductions to be allowed only on actual payment, not on accrual basis, but when the payment has been actually made, deduction in respect of such payment will be allowable. Deduction is allowable only if the sum is actually paid on or before the due date of filing of return under section 139(1) for the said previous year. Otherwise, the same would be allowed only in the year in which the sum is actually paid. They are tax, duty, cess or fee under any law for the time being in force, not income tax. Other than income tax, any tax, duty, cess or fee under any other law will be allowable as deduction only if the actual payment is made. Contribution to any provident fund or superannuation fund or gratuity fund or any other fund for the welfare of employees. bonus or commission for services rendered by employees, where bonus or commission is not a substitute for profits or dividend. Interest on any loan or borrowing from any public financial institution or a state financial corporation or a state industrial investment corporation. Interest on any loan or borrowing from notified class of NBFCs. Interest on any loan or advance from a scheduled bank or cooperative bank. Payment in lieu of any leave at the credit office employee. Any sum payable to Indian Railways for use of railway assets. So these are the deductions under section 43B, which will be allowed only on actual payment. Now let us head to the next section. So the next section, section 44A, talks about maintenance of books of accounts. The first case is in case of notified professionals. How should they maintain books of accounts? First, let us know what are who are the notified professionals. Any person in legal, medical, engineering, architect, accounting, technical consultancy, interior decorator, film artists, company secretary, information technology, or an authorized representatives. These are called notified professionals, and the conditions for these notified professionals to maintain books of accounts are either if the gross receipts exceed rupees 1.5 lakh in all three preceding previous years, or gross receipts exceed rupees 1.5 lakh in previous year in which profession is newly set up. The first condition is if in all the three preceding previous years the gross receipts exceeds rupees 1.5 lakh each. Otherwise, if in case of a newly set up profession in the previous year, it exceeds gross receipt exceeds rupees 1.5 lakh in the previous year in which the profession is newly set up. In such a case, they are required to maintain books of accounts as per our income tax provisions. What are the books of accounts to be maintained? The assessee engaged in such profession shall maintain prescribed books of accounts as follows: the cash book, journal, ledger, the carbon copies of bills issued more than rupees 25, and original bills received in case they exceed rupees 50. Also, in case of medical profession, daily case register and inventory of drugs and medicines registers should be kept. Coming to the next case, persons carrying business or profession mentioned in the point 1. Persons carrying business or profession other than the profession carried in the case 1, that is other than notified professionals, the other professionals are covered here. Such assessee shall maintain books of accounts if in any of the three preceding previous years. In case of individual or HUF assessee, if the income from business or profession exceeds rupees 2.5 lakh, or the turnover or gross receipts exceed rupees 25 lakh, either the income should exceed rupees 2.5 lakh or the turnover or gross receipts, as the case may be, should exceed rupees 25 lakh. In such a case, the individual or HUF must maintain books of accounts. In case of other assessees, if their income exceeds rupees 1.2 lakh or the turnover or gross receipts, as the case may be, exceeds rupees 10 lakh, either the income should exceed rupees 1.2 lakh or the turnover or gross receipts should exceed rupees 10 lakh. They have to maintain books of accounts in case of assessees other than individual or HUF. Other cases where the assessee has to maintain books of accounts. In case of business or profession newly set up, if the income or turnover or gross receipts exceeds the above mentioned limits in the previous year in which it is set up, the business or profession has been newly set up in the previous year, and immediately in the previous year itself, either the income is exceeding the prescribed limits or the turnover or gross receipts, as the case may be, is exceeding the prescribed limits as above. In such a case, in case of such newly set up business or profession, the assessee has to maintain books of accounts. When assessee is showing lower income as compared to income computed on presumptive basis under section 44AE. Let us discuss about 44AE further. For now, let us remember this point, that when the assessee is showing lower income as compared to income computed on presumptive basis under section 44 AE, he has to maintain books of accounts as prescribed by income tax provisions. The next case, where an assessee not eligible to claim the benefit of provisions of section 44 AD for 5 assessment years due to him not declaring income as per presumptive taxation in immediately preceding PY. Here, assessee is not declaring income as per the presumptive taxation under section 44 AD. In such a case, he has to maintain books of accounts. Books of accounts are kept at principal place of business or profession and are retained for at least 6 years from the end of relevant assessment year. From the end of relevant assessment year, the assessee has to maintain these books of accounts for at least 6 years. And these books of account are kept at principal place of business or profession. Penalty in case of contravention, rupees 25,000. So, rupees 25,000 penalty will be paid by assessee in case he contravenes any of these provisions. Now let us discuss the next topic, that is presumptive income provisions under section 44 AD. Section 44 AD is applicable to resident individual HUF firm which is not an LLP. So the eligible assessees are resident individuals or HUF or firm. It is not applicable to professions under section 44 AA. That means notified professionals. Agency business or person earning income by way of commission or brokerage. The condition to claim to pay tax as per the presumptive income provisions is no deduction is claimed by assessee under section 10 AA or chapter 6A. And the assessee should be engaged in any business but not of plying, hiring or leasing of goods carriage. Also, the total turnover or gross receipts does not exceed rupees 2 crore. So what is the eligibility? The assessee is resident individual, HUF or firm and not an LLP. The ineligible assessees, the presumptive income provision under section 44 AD is not applicable for notified professionals under section 44 AA, agency business or person earning income by way of commission or brokerage. No deduction is claimed by assessee under section 10 AA or chapter 6A. The assessee cannot claim deduction. The assessee is engaged in business and not business of plying, hiring or leasing of goods carriage. The total turnover or gross receipts does not exceed rupees 2 crore. These are the conditions for eligible assessee. And what will be the presumptive income? If aggregate cash receipts in the relevant previous year is less than or equal to 5% of total turnover or gross receipts of the assessee of higher turnover threshold of rupees 2 crore would be applicable. Here we have discussed about the condition where the turnover or gross receipts should not exceed rupees 2 crore. But if the aggregate cash receipts in the relevant previous year does not exceed 5% of total turnover or gross receipts, that means in the total turnover or gross receipts, the cash receipts aggregated to only less than 5%. In such a case, the turnover threshold of rupees 3 crore would be applicable. Even if the assessee's turnover is 3 crore, presumptive income provisions are applicable to such assessee. The income under section 44 AD will be considered as follows. Income is equal to 8% of gross receipts or turnover or such higher sum claimed by the assessee. The income will be either 8% of gross receipts or total turnover or such higher sum claimed by assessee, which also the presumptive income would be 6% if total turnover or sales in respect of amount which is received by an account payee check or by an account payee bank draft or by use of electronic clearing system through a bank account or through such other prescribed electronic modes. Here we are considering income in general as 8% of gross receipts or turnover. But if the amount of turnover or sales is received either in either of these 4 modes, account pay check, account pay bank draft, electronic clearing system, or any other prescribed electronic mode. Only if in these 4 modes the turnover or sales receipts are received, then the income will be presumed as 6% only. 8% in general and 6% if the turnover or sales are received in either of these 4 modes. I hope it is clear for you. So, section 44AD, it deals with only, it is applicable only for resident individual, HUF or firm and not LLP. The assessee should be engaged in business and not of plying, hiring or leasing of goods carriages. He should not claim deduction under section 10AA or chapter 6A. His aggregate cash receipts in relevant previous year, his total turnover or gross receipts does not exceed 2 crore in general. But if the cash receipts in total turnover aggregates to less than 5%, in such a case, higher turnover limit of rupees 3 crore will be applicable. The income will be 8% of gross receipts or total turnover in general, or such higher sum as claimed by the assessee. Otherwise, instead of 8%, we will claim 6% of turnover or sales only in case the turnover is received in either of these 4 modes. Set off carry forward and set off of losses is allowed. Set off of losses or carry forward and set off of losses from previous years, preceding years will be allowed. Unabsorbed depreciation is not allowed in case of section 44AD. I hope everything is clear for you regarding section 44AD. Now let us head to the next section, section 44ADA. It is applicable to resident individual HUF or firm and not an LLP. And such resident individual or HUF or firm are engaged in profession referred to in section 44AA. That means notified professionals. Section 44ADA is applicable to notified professionals and they are either individual, HUF or firm, and they should be resident in India, whose total gross receipts does not exceed rupees 50 lakh in previous year. The gross receipts of such assessees should not exceed rupees 50 lakh to claim presumptive income provisions under section 44AD, to avail the benefit of presumptive income provisions. And instead of this rupees 50 lakh limit, if the aggregate cash receipts in the relevant previous year are less than or equal to 5% of total turnover or gross receipts of the assessee, a higher gross receipts threshold of rupees 75 lakh would be applicable. Generally, the threshold limit is 50 lakh. If his total gross receipts does not exceed rupees 50 lakh, he can avail the benefit under section 44ADA. He can claim income as per section 44ADA. He can declare income. But if out of total turnover, the cash receipts are aggregated to less than or equal to 5% of such total turnover or gross receipts, in such a case, even if the gross receipts of the assessee go up to rupees 75 lakh, he can claim, declare income as per section 44ADA. The income under section 44ADA is 50% of gross receipts or such higher sum claimed by the assessee. Assessee can claim any higher amount also, other than 50% of the gross receipts in such previous year. So the presumptive income will be either 50% of gross receipts in the previous year or any higher sum claimed by the assessee, higher than this 50% of gross receipts. I hope it is clear. Now let us head to the next section, section 44AE. Section 44AE is applicable to assessees who are engaged in the business of plying, hiring and leasing goods carriages. They should not own more than 10 goods carriages at any time during the previous year. If the assessee owns more than 10 goods carriages at any point of time during the previous year, he cannot avail of, he cannot declare income as per section 44AE. For each heavy goods vehicle, the income will be declared as follows. For each heavy goods vehicle, rupees 1000 per ton of gross vehicle weight or unladen weight per month or part thereof during which such vehicle is owned by the assessee. For each vehicle other than heavy goods vehicle, rupees 7500 per month or part of a month during which such vehicle is owned by the RCC. For heavy goods vehicle, for each of them, rupees 1000 per ton of gross vehicle weight or unladen weight per month or part thereof, during which such vehicle is owned by the RCC. And for each vehicle other than heavy goods vehicle, rupees 7500 per month or part of a month during which such vehicle is owned by the RCC will be the income. Or other than these incomes, the RCC can claim any amount higher than these limits. An amount claimed by RCC whichever is higher will be declared as the presumptive income of such RCC under section 44AE. Now let us discuss section 44AB. Section 44AB talks about the mandatory audit of accounts of certain persons. Let us see in what cases it is mandatory to conduct the audit of accounts of books of accounts of the RCC. The first case is in case of person carrying on any business, if the total sales, turnover or gross receipts exceed rupees 1 crore in relevant previous year. The RCC carrying on any business and his total sales or turnover or gross receipts, as the case may be, is exceeding rupees 1 crore in relevant previous year. And if aggregate cash receipts or payments in the relevant previous year, if it is less than or equal to 5% of total receipts or payments, the limit would be 10 crores. If the gross receipts or turnover exceed rupees 1 crore, it is mandatory to audit the books of accounts. But if the total receipts or total payments, the cash receipts or cash payments in the relevant previous year does not exceed 5% of total receipts or total payments, in such a case, instead of rupees 1 crore, the limit will be rupees 10 crore. Up to 10 crore, there is no need of mandatory accounts if the aggregate of cash receipts or payments in the relevant previous year does not exceed 5% of total receipts or payments. The second case is in case of a profession, when gross receipts exceed rupees 50 lakh in any previous year. In case of profession, when the gross receipts exceed rupees 50 lakh in any previous year, it is mandatory to conduct audit of books of accounts. Section 44AD, the third case deals about section 44AD assessees. Assessees covered under this section are not required to maintain books of accounts or audit their accounts. But when the assessee, after being covered under the presumptive taxation, chooses to declare his profits less than 8% or 6%, we know that under section 44AD, either he has to declare profit as 8% or 6% as the case may be, or the assessee can claim any higher amount. But here the assessee is claiming that instead of 8% or 6%, his income is less than 8% or 6% of his gross receipts. He is declaring his income less than the limits as prescribed under presumptive taxation. When the assessee, after being covered under presumptive taxation, chooses to declare his profits less than 8% or 6% of his gross receipts by claiming all deductions on expenditure incurred, that is, assessee is opting out of presumptive taxation, then assessee will be disallowed for 5 subsequent years to declare profits under presumptive basis. So, if he declares lower income than 8% or 6%, he is claiming income, he is opting out of presumptive taxation scheme. In such a case, the assessee will be disallowed to pay tax under presumptive taxation for the subsequent 5 years. He cannot declare profits as per the presumptive taxation for subsequent 5 years. Suppose if the income declared not as per the provisions of presumptive taxation exceeds basic exemption limit, then he has to maintain books of accounts and get them audited. Here he is claiming income lower than 8% or 6% of gross receipts, but his income is exceeding the basic exemption limit. In such a case, he has to maintain books of accounts and get them audited. Then the tax audit is mandatory. The fourth case, in case of assessee covered under section 44AE. In case of an assessee covered under section 44AE, claims that the profits and gains from the business in relevant previous year are lower than the profits and gains computed on presumptive basis under section 44AE. 44AE deals with assessees engaged in business of flying, hiring or leasing goods carriage. They are claiming income lower than the profits and gains computed on presumptive basis. In such a case, they should get their books, they should maintain books of accounts and get them audited. In case of an assessee carrying on a notified profession under section 44AA, claims that the profits and gains from such profession in the relevant previous year are lower than the profits and gains computed on a presumptive basis under section 44ADA. The notified professionals are claiming that their income is lower than the profits or gains as computed under the presumptive taxation basis under section 44ADA. In such a case, they have to maintain books of accounts and get them audited mandatorily. So these are the 5 cases of mandatory maintenance of books of accounts and their audit. Now let us discuss the next section, section 40B. Section 40B discusses about remuneration to partners of a partnership firm. Remuneration can be paid either in the form of interest on capital contribution by the partners or salary, bonus or commission, etc. In case of interest on capital, it is allowed to all the partners as per the partnership deed, and the maximum can be 12% per annum on simple interest basis. The interest on capital is allowed to all partners as per the partnership deed, and the maximum amount could be 12% per annum on the capital and on simple interest basis. The salary, bonus or commission, etc. paid to partners is allowed as deduction only to working partners, only if it is mentioned in the partnership deed. Salary, bonus, commission, etc. is allowed to be paid to working partners only as per the partnership deed. The maximum amount of salary, bonus or commission payable is as follows. On the first rupees 3 lakh of the book profit, or in case of a loss, rupees 1,50,000 or 90% of the book profit, whichever is more, can be paid as salary, bonus or commission. On the balance book profit, only 60% of the book profit can be paid in form of salary, bonus or commission. What is book profit? Book profit is PGBP, profits and gains from business or profession of firm before any interest or remuneration. We should not provide any deduction for interest or remuneration on such profits, minus brought forward unabsorbed depreciation if any. Profits or gains before claiming interest or remuneration minus brought forward unabsorbed depreciation is the book profit for calculation of remuneration to partners. The last topic under PGBP is taxability in case of composite income. Sometimes the income from the business composes of the business income as well as agricultural income in these following cases. In such a case, what is the portion of taxable income? What is the portion of exempt income as under the agricultural income? Let us see. In case the income is received from sale of rubber products derived from rubber plants grown by the seller in India. Out of such income, 35% will be business income and 65% will be exempt as agricultural income. Any income from sale of coffee which is grown and cured by the seller in India. It is grown and cured by the seller in India. Then 25% of such income will be business income and 75% will be exempt. The income from sale of coffee grown, cured, roasted and grounded by the seller in India, out of that 40% will be taxable as business income and 60% will be exempt as agricultural income. Income from sale of tea grown and manufactured by the seller in India. In such a case, 40% will be taxable as business income and 60% will be exempt as agricultural income. So with this, we have completed revising the chapter PGBP, income from the head PGBP, and further We will discuss the other heads of income as well as the other chapters under the subject taxation. I hope this video is helpful for you guys in revising the chapter, and keep watching Swadhyay for further lessons. Thank you.